Okay, what we're going to look at here is the deductions that some employees are allowed to take from their employment income. So the first thing there's three things I think that we need to note about these deductions right off the top. One, they have to be required by the employer. So this is not a case where an employee can just say, I have these employment expenses and I'm going to put them on my tax return and reduce my income that I have to pay tax on. It's not up to you. Your employer has to require it of you. Okay, that's supposed to be a 1. Okay, so that's really important. And then related to that then is these are really limited. There aren't very many of these things that people have access to. And then the last thing is that they have to be, again, this word comes up, reasonable. So even if you are required by the employer, the amount that you claim has to be reasonable in the circumstances. Okay, so let me just set up a scenario here so to make sure that we don't get all bogged down in these little nitpicky rules. Think about a scenario here where I have an employee who has travel costs, and we'll talk about who's allowed to deduct these. But assume this is he is someone who likely could be able to deduct these things. So he incurs costs of $3,000. So the options for him to be made whole, because he did incur these for business, so he shouldn't be out of pocket for these. So obviously we've learned about reimbursement, right? So the company could just say, okay, you spent it, submit your receipts, and you will be made whole and everybody's okay, right? So reimbursement we're familiar with, and that's what most of us as employees in accounting firms, when we incur these costs, we submit receipts and get reimbursed, and we're made whole. The other way is through an allowance. And so, come on. If the allowance, so let me just be a little careful here, sorry. So reimbursement. So an allowance, if it is reasonable, it will be exempt. Okay, so not taxable, not included in income. So what we're going to say is we will not, in the case of the allowance, no income, no deduction for the $3,000. So he has been made whole. The company has given him $3,000. He's spent $3,000. Everybody's happy. In the reimbursement, he's spent $3,000. The company's given him $3,000. Everybody's happy. But what if neither of these happens? This is the situation that we're in now. It looks like, well, wait a minute, the company is not reimbursing him. So it looks like he is out of pocket. And that seems a bit unfair. So if you think of the other two, think of the allowance as the baseline, really what this is in reality is the salary that he is being paid is designed to cover these costs. So when they set up his employment contract, they said, okay, you will pay your travel expenses and we will pay you a salary. The problem with that is this is taxable. So he's not whole now, right? He's receiving this additional salary to be that's supposed to cover these costs that he's required to incur, but he's getting taxed on the salary and getting no deduction for the expenses. So that's why these need to be deductible. So that this scenario where there is no reimbursement and no reasonable allowance matches the ones where there is, the situations where there is. Okay? So hopefully think about it that way. Don't get all bogged down in the nitpicky rules. So let's look at some little nitpicky rules. The first thing we have to note is commissioned salespeople. So these are people who earn income based on how much business they do. So we think of a salesperson. If they make a sale, they get a commission off of that sale. If they don't make a sale, they get nothing. And even though these people are employees, so these are employees, going back to our previous discussion about employees versus self-employed, they are employees. And so the Income Tax Act has to say, okay, well, what do we do with them? Because they're employees. But the fact that they're commissioned really results in their commission is like revenue. And so, to my mind, the way the Income Tax Act treats commissioned salespeople is it simply turns them into a business. So it makes them look like they are running their own business. And so they are very unconstrained in what they can deduct against their commissioned income. And I'll leave you to look at the textbook, but the main takeaway is that it's business income being reported on the employment income line because of the structure of the relationship. Okay? The trickier one is these non-commissioned people. So when I have non-commissioned people, but I require them, or the employer requires them to do something like travel, well, what do I do if there is no reimbursement and no reasonable allowance? So in the case of travel, the specific travel, so let's think about what costs do you incur when you travel? Well, and again, this is important to note, not car. Okay, car is treated separately. So we're talking about planes, so transportation, trains, planes, and leaving out automobiles. You guys probably don't even remember that movie, classic movie from my generation. Transportation, other than car, and meals, which are limited, but we won't get into here, and then lodging. That's pretty much those are the costs you incur when you travel. So when can we allow people to deduct these costs? Well, the CRA says, okay, here's when you can do it. If travel is ordinarily required. So this is not sending someone off on a trip once every 3 years. This is somebody whose job it is to travel, but they are not commissioned. So they're normally traveling, but they're not commissioned. 2, they have the contract says, their contract with their employer says employee pays. Okay, so it has to be specifically stated, just like in the T2200 has to say we require this to happen. And the last thing, I think I might have skipped by that. This T2200 is a form that has to be filed signed by the employer and filed by the employee. I apologize if I didn't mention that. 3, there's no tax exempt allowance, meaning reasonable. Because again, if there is an allowance being given and it's reasonable, then that employee is whole, and so we don't need to allow him to deduct these expenses. Okay, but if that is met, if these 3 conditions are met, then he can deduct those things. End of story. Why? Because it's basically replacing the allowance or the reimbursement. Second thing, most common type, is home office expense, and this is becoming more and more common as more and more companies are thinking it's more cost effective for us to have people work at home. The limitations of having them at home are much smaller because of the ability to interact electronically now, and so this is becoming more common. And so if you have a home office, you have to meet one of 2 conditions. So first of all, it has to be required. That's still there, so all the same conditions apply here. You have to use this space. Use the space. So the space within your home that you are calling your home office has to be used. Let's use some short form here. Greater than 50% of the time. So not of the space, but of the time. So this space that you're claiming is your home office within your home has to be used more than 50% of the time for your business. If you fail that test, which is the one most people meet, so there's an or here. If you fail that test, then there's these 2 other subtests that are an and, which is the the space is exclusively for the office. So you don't use it for anything else. It is your office and nothing else, which is uncommon for most people who don't have unlimited space in their house. And then 2, it has to also be regularly and continuously, which is hard to imagine in this case, but the language is not perfectly chosen. Regular and continuous meetings, so business meetings with people held in this space. Okay, those are the conditions. Almost everybody who needs to qualifies under that one. So once you are qualified, well, how much can you write off? And what can you include as the deduction? Well, it's just like cars, and usually it's done based on square footage. So square footage, that is the office, over square feet footage that is in the total house, or livable space within the house. You multiply that by allowable expenses, and there's your deduction. Okay, so it's very reasonable. It's kind of the cost of having this office in my house. I'll refer you to Exhibit 3.3 on page 124 for the list of what is included and what isn't, but it's I'm sure you could construct it pretty much in your head now, and nothing there is going to surprise you. The next, so that's really it. Like really, except for cars, which we'll do at the end, that's it. Home office and travel are really the only things. They're all the other stuff that comes up. So it's mentioned in section 3350. These are all really special cases. You know, we've got things like clergy and railway and transport people and artists, kind of uncommon. Okay, the next thing that is common to a lot of people, though, before we get to cars, is registered retirement plans. And so we don't want to confuse this. You remember when we looked at income inclusions, we talked about, well, when the employer makes a contribution, is that a benefit? This now is a separate issue. This is contributions made by the employee. So this is it's the same. The money's going to the same place, but this is distinct from what we talked about last time. And essentially, what this is if you can put away 18% of your earned income. That's the cap. So it's the lesser of 18% or this standard cap for everybody, which in 2011 was almost $23,000. So the lesser of, if you can put those away, you can deduct the amount. So the deduction is the amount contributed, capped at this, right? So this is those are the caps. So that tells you how much you can put in. But as much as you can contribute to a retirement plan, you can deduct from your income now. It will then be taxed when you take it out in retirement. Okay, fairly straightforward. So last thing we want to look at then are these car expenses. So the most important thing with car expenses is to keep them as separate as you possibly can from benefits, right? So make this big, thick wall in your mind between this and benefits, because we tend to get confused between these two things, and because they're both cars, and there's these formulas and things, but this is very, very different. What we're talking about is, can I deduct what I pay? So the expense is the employee's out of pocket. Right, and this is when the employer pays. Is there an income inclusion? Okay, so please keep those two things very separate in your mind. And once you do that, car expenses are not complicated. They make really quite perfect sense. You just think about, what are the costs of owning the car? What are the costs of owning and operating a car? And we are all fairly familiar with these things, right? So we've got things like, you have to buy it. So the price. And if you don't do that, and if you do that, you might have to borrow the money to do it, and so there's going to be interest, or you could lease it instead. But either way, there's going to be it could be an annual outflow depending on how you finance this purchase. Then there's just gas and maintenance and insurance and other, so registration fees, things like that. So anything that you need to incur to have this car running, all of this should add up to, the total cost of this car. Multiply that by business kilometers over total kilometers, and that's your deduction, as long as you meet all the requirements to be allowed to take the deduction. Your employer is not giving you a reasonable allowance for it, is not reimbursing you for it, then that's your deduction. This, of course, is tricky because there's this concept called CCA, which we can just translate until we get there as depreciation. So we obviously can't deduct the entire purchase price in 1 year, so we just take a portion of it, and that's capital cost allowance. In our minds, depreciation. All of these other things, we just add them up for the year, and we'll get our number. Fairly straightforward.